so you could
Sure. Um, and then pleasure to have you guys all on the call. My name is John deRoulet. I'm the head of revenue management education here at Wheelhouse. Not sure if you guys have seen me around, but I do a lot of kind of educational series, talk a lot about revenue management, and I work with a lot of our clients directly on just kind of revenue strategy and using the Wheelhouse platform for people who are using Wheelhouse. Been a revenue manager in the space for a long time. I have been with Wheelhouse about 4 years, and prior to that, I was with an organization called Stay Alfred for about 8 years, where I acted as the head of revenue management for a portfolio of about 3,000 listings across 33 market areas. That was primarily urban inventory then, but in that time since Stay Alfred, did some consulting. I've worked with quite a lot of traditional destination vacation rental markets as well. So a lot of experience in the space, and really just enjoy getting the opportunity to talk to people about revenue management and about kind of what's going on in different markets. The format for this call is really pretty informal. So I'm going to go through some data with you, but I'd also love to have a conversation. If you guys decide you don't really feel like participating right now, that's fine. I'll move forward with just kind of showing you some data. But I think having a discussion makes it a lot better. And so, I'll kind of pass it off. Would anyone like to introduce themselves, kind of tell me who they are, where they're, a little bit about their portfolio, a little bit about their business, and yeah. Anyone want to volunteer to go first?
I'm just a backup for the rev manager. I'm Jenny. That's all I have to say. Thanks.
Okay.
And I'm Jeff Jensen, the, CEO of Buckingham in Lake Tahoe.
Hi, I'm Rachel. I'm the marketing manager at Tahoe Luxury Properties.
I'm Dan Carpenter. I work for Granite Peak Management, and I do the revenue management for our properties that we manage.
Awesome. So pretty good mix of revenue managers and CEOs. Well, really everybody except for operations folks, I suppose. Appreciate you guys being on the call. First thing I like to start off with just a little discussion. We'll see how much you guys want to participate here. But before we kind of jump into some data, but how do you guys think things have been going so far this year? Like, what is the trends that you've been seeing in your own portfolio? Does it match kind of expectations from the beginning of the year? What do you guys think has been going on for you individually?
We're down. So, I think we've seen a downward trend the last, so I'm going to say 24 to 36 months. And we're doing everything we can to, enhance marketing and enhance strategy around it, but we're definitely down and seeing a downward trend. I think it's macroeconomic and inventory. I think there's a lot more inventory that's in the market today than there was 3 years ago.
Makes sense. And when you say down, are you primarily thinking like you're seeing that you're down in occupancy and then the ADR is following, or are you maintaining occupancy but doing so at a lower rate?
I would say the occupancy's down, and so we're pairing that with lower rates to try to get ahead of it, but we haven't been able to do it yet.
And what's your inventory like? Like, are you like super big luxury? Are you got a pretty big mix?
Pretty big mix. 50% long-term, 50% short-term. We'll add some more short-terms back in now that Measure T's been repealed. And we're pretty much 50-50 between Nevada and California.
Awesome. Anyone else like to share what they're seeing? Are you guys also seeing the market be down, under a lot of pressure, a lot of extra inventory?
Yeah, we're noticing the same exact thing, basically. What we're also realizing is our median range properties. Those are the ones that we're having the most difficult times with. Our unique properties, or our, the ones that are a little better and higher demand, those ones we are seeing higher ADRs with this year, but overall our occupancy is down. And our lower quality ones, which we always have our lower rates, we see them doing fairly decent. It's like I said, it's our median range properties that we're really noticing the lower occupancy and lowering our ADRs.
Interesting. Yeah. On the last revenue management roundtable, last two I've had on, it tends to be pretty consistent that the revenue managers around the country are saying that the luxury segment is still pretty stable, like the highest end segment. It's interesting for you to say that the lowest stuff is actually doing fine, but maybe that's because you guys never are pushing beyond what you kind of know it can do. I've heard a lot from revenue managers that mid segment, especially the mid segment that's like not like has benefited a lot from ADRs rising over the last, not really last year, but the last couple of years, but really are now really competitive. Is that also where you see a lot of, like, where are you guys seeing the biggest like inventory increases coming in? Like, is it in that luxury segment, or is it also in that kind of mid segment?
Yeah, we're seeing it in the mid segment, and we're also, I think, part of our challenge too is getting the owners of these properties to recognize that we're sort of out of this boom. A lot of them still are expecting those higher ADRs and higher returns, and we're just noticing that market. It's it's the hype after COVID. It's definitely coming down.
Yeah, absolutely. I think that's a national revenue management struggle. Maybe we can talk a little bit later about like what data is available for you guys to kind of help make that case. Appreciate that. Rachel, Nicole, do either of you guys want to chime in on what you guys are seeing in your portfolios?
Same sentiments. I'm actually like brand new too. I'm like 3 weeks into my role, so don't have a ton of background, but from what I'm hearing from the company, very similar. We're seeing a lot of like kind of lower tier houses even want to just list and go on the market and not be in vacation rentals anymore. But we are seeing some luxury rentals still want to be part of our collection, and we're about to onboard 3 new ones. So that part doesn't seem to be going away.
Awesome. Yeah, it's interesting. So we do this with markets kind of all over the country. And that trend of like the last few years, huge increases in inventory, probably people overpaying what like the stabilized kind of revenue can support over time. And just creating a lot of pressure on occupancies for property managers in those markets. There are a few markets that are starting to turn onto the other side or had been very restrictive. And they're telling like a very different story than kind of what you're hearing across the country in terms of like pressure through Q1. Basically, like if you look at a market like Charleston or Savannah, they're markets that put in really strict ability to get short-term rental licenses, and they're actually maintaining pretty good strength in pretty much the entirety of Q1 into Q2. And I think that's pretty interesting because that inventory growth is affecting most markets across the country, and it's probably not going to go away as fast as it kind of built up. I think that the kind of like sunk cost of being in a property or trying to figure out what you're going to do, it's a lot harder for people to get out of it than it is to get into it. And we've seen some markets that have been like, they're like slowly slowing their growth. Like Phoenix is a big one, or Orlando, but there's still that gap that's putting a lot of pressure on occupancies that's kind of coming to a head when you have macro conditions affecting demand. I think that one thing to keep in mind is usually for almost all of the markets across the United States that have really high inventory growth, the occupancy pressure is not coming from a retraction in what am I trying to say? A retraction in travelers. Like travelers aren't shrinking, like that hasn't gone down yet in pretty much any market unless there's like a major emergency event or something. What's happening is the growth in inventory is outpacing the growth in travelers over, you know, a couple of years, and that's where that gap and that pressure is coming from. I like to clear that up because sometimes people I talk to are a little unclear. They're not sure if like travel is going down but really what's happening in most of these markets is that inventory has been outpacing travel significantly. Now, there are some macro conditions that may be affecting that. And why don't we jump into some market data? Hi, Katie, I saw you join. Do you want to maybe introduce yourself, say hi, and just let us know what you're seeing in the market before I move on?
Yeah, absolutely. Hi, everyone. I'm Katie. I'm a property manager in North Lake Tahoe. I think we're just seeing a little bit of a slower pickup in the summer season for some of our properties that have been historically pretty good bookers since COVID. So with the market softening, just trying to get a little bit more understanding of what we can do to make sure our occupancy and ADR is on par as much as possible for the summer season.
Awesome. Thank you. Okay, so I am already sharing my screen, apparently. The first thing that I'm going to bring up, so I'm going to walk us through Wheelhouse market reports, and then we're going to potentially dive into a place where we can get into a little bit more granular data. First thing to note, Wheelhouse market reports are kind of high level. You can see we're kind of covering the whole area, even up towards Reno in some places. It's going to be just kind of high level aggregates, but it's a good way to just primarily look at trends, overall trends across the market. This is free data, actually. If you sign up with Wheelhouse, you can access any market report in any market in the world that we have for free. And we do have great visualization. So I know I think Rachel mentioned, or sorry, I can't remember who mentioned it, but telling that story to owners, maybe it was Dan, is getting kind of difficult to show them that the boom is past. You do have access to this data, whether or not you're a Wheelhouse user. There's something else before I dig into the Wheelhouse side, which is going to be primarily focused on short-term rental data, obviously. But I did poke around a little bit earlier today, and I don't know, did you guys ever go to the Visit Lake Tahoe site? They share a lot of really good data on your market. You guys probably have one of the stronger CVBs that I've seen. There's a lot of different data, but you know, this can also be useful for kind of just getting a pulse on what's going on around you, particularly because they're going to tell you a little bit of the hotel side. They've essentially posted the March entire STAR report for the region, which is kind of interesting because, you know, obviously what's going on in hotels is not the same as what's going to go on vacation rentals, but there are going to be some interesting things that you can pull out of here. So like, let's hop down to here. This is like some different regional stuff, which I think is interesting. In March, South Lake Tahoe, little loss in occupancy on the hotel side, big loss in occupancy in North Lake Tahoe on the hotel side, but they're still pushing ADR a little bit. So that's always going to be a mismatch you see with the hotel side. They're going to be less concerned about losing occupancy than they are about ADR. So when you see that they're under a little occupancy pressure, it's usually a good signal that there's going to be consistent occupancy pressure. Now, when you look year to date, though, they were up on South Lake Tahoe, but down in North Lake Tahoe. I think these are kind of interesting things just because Smith Travel Research is a big, this is like really expensive data to buy, so I'm surprised they're able to show it, especially against like other markets in the area. I'm not sure if they're going to continue to post this. This is the first month that they've really posted a STAR report. But anyway, kind of an interesting resource for you guys. For me, I think the most interesting aspect here when I was looking at some of the data available through the CVB was essentially how much travel comes sources from California in terms of spend. That the international probably isn't having as big of an effect on the market, but it's something to consider, right? Like, you know, particularly like if you look at these spend amounts from Mexico versus San Francisco, it's a really small portion. So some of in Canada too. Now these are big changes though, but that's kind of something for you to look into. The hotels are seeing big drops in some of these. Mexico's actually up, Canada's down, but not big overall amounts of their business are coming through. Now, the big thing for hotels that's going to be different from us is the hotels are dealing with a lot of this like day travel, which the STRs aren't going to get. So take some of it with a grain of salt. But if you're building a kind of trying to explain to owners what's going on, sometimes the hotel reference data can be useful, and they always give you good kind of overall trend analysis. So this is just on your CVB site. I think you guys have a lot of actually a lot of data on that CVB. If you haven't checked it out, it's worth checking out, especially if you're trying to make a case or put together your own case for what's going on. Let's hop into the Wheelhouse data though. So I'm on this Wheelhouse market report. I'm going to grab this little pen here. Can you see this when I draw? Okay, cool. And the first place I'm going to go is this trend section. So trends are a pretty easy way for us just to see kind of month over month, year over year occupancies, or really any other statistic. I like to start on just the adjusted occupancies. Keep in mind, we are looking at both North and South Lake Tahoe at the same time right now. So we'll get kind of a mix between whatever's going on for winter and whatever's going on near the lake. Oh, come on. Sorry, my Chrome froze up a little bit. And, you know, few just notes. We're looking at all performance groups. So we're really looking at everything. This is just going to be like a total aggregate of the market. We're looking at all bedroom counts. And for me, I'm really just looking for trends here, right? I'm also going to pull off 2023 just so there's a little less to look at. I think it gets a little too confusing when I've got too much at once. So in terms of January, February, pretty stabilized occupancy level across the entirety of the market, right? It's really March where you start to see that attrition occur. And it continues into April, right? We're losing some ground here overall. Now, this is kind of interesting to me too, because we also saw this in the hotel data that January, because we infer it from the hotel data, right? In the sense that March was way down, but the year to date was up a little bit. That means that somewhere there had to be a little bit of an increase. And that January is also showing a little bit of an increase here. Did you guys see a little bit of that in your portfolios? Okay. What do you guys think is really causing, like, is there any specific causes or any specific like events or things that might be missing that might have contributed to these attrition rates in March or April? Or do you think it's like mostly attributed to macroeconomic conditions, to just competition as as we know that the season turns down also?
Yeah, we didn't have great snow either, so it wasn't a good winter for us here.
But we
So
had
the snow ended early.
days with the mountain. The skiing was actually good. March and April have been good, you know? Like it was beautiful weather, full coverage, open the whole mountain. I don't know.
I think it's macro was my kind of take on it. It's what we're thinking.
Yeah.
I agree.
One quick question in your portfolios: do you guys take one night stays, or are you mostly 2 to 3 night plus?
2 to 3 plus.
Okay, yeah. That makes sense. I asked because I didn't show you guys this on that kind of third-party data I was looking at, but there's actually like a really large amount of like day trip stay in Lake Tahoe. It's actually like a majority of what they track for spend at the CVB level, which isn't going to affect our industry. And then that single overnight is going to kind of affect like hotels, but not us. So where they may have a little bit, like their occupancy was down, but it wasn't down a ton in some areas, but ours is going to be hit a little bit more because we're not going to get that kind of like same short business, right? That might be occurring last minute. That might be associated with like, weekday skiing, things like that. I would assume you still need a little bit of planning or a little bit of willingness to like take some time off of work. The macro things I think are interesting because I agree with you in the sense that there's a lot of whenever financial information is in the news, it's going to cause it usually causes slowdowns in sales like across the board, right? And I think that they're probably compounding, right? You probably have macro stuff, but that's really, I think it's not really occurring till April, right? Like when the news really starts to get taken over with financial news is around the beginning of April. So it's a little early for March, and it's probably going to be affecting pickup out here the most, I think. Now that's my opinion.
The
Yes, go
other
ahead.
factor that I think might be affecting this data is a lot of companies in the Bay have started to do return to offices, where we used to see a little bit more of a spring and fall like midweek stay. And I'm wondering if that could have some market influence as well.
That is probably absolutely true, because if we pop back over here, and this is corroborated in other reports that are on the CVB side where they're tracking source spending. San Francisco is the largest source spending market for Tahoe by almost double the next largest, which is San Jose, which is like, isn't that also in the Bay Area? Which is, you know,
Yeah.
so between these, this is like what, 3-4x the next largest source market for spend. That's a good point. That's a good story to tell to owners about like where, you know, the competition is going to be, because obviously when these peak times are happening, it's still pretty stable. But when occupancy is low, everyone's going to be under a lot of pressure. So quick question before we dive into a little more data. What are you guys doing strategy wise? Like what is your approach to, we're past April, but like May right now, and are you thinking forward into like September, October, into these other shoulder seasons where competition is going to be the highest?
I mean, we're doing last minute discounts and we're lowering our nightly rate, but there hasn't been a ton of pickup even with those changes for us. We are seeing people start to book in September and October, which I think might be them just like trying to secure something. Maybe they wanted to come in the summer and couldn't afford to, and that's when we have a little bit lower travel cost. So that was my thought on why we're having fall pickups already, which is, I would say, a little bit out of character.
Yeah. Is that in your like larger home, more luxury segment? Or are you also seeing that in your mid segment?
I would say we're seeing that more in our mid segment.
Interesting.
Mid segment, but also our lakefronts. So yeah, I guess.
Yeah, that's interesting. I wouldn't expect that. Well, I kind of take that back. I think that my hunch is that generally across vacation rental markets, people consistently overprice, and it's kind of a psychological thing. When you start as a smaller PM, you have a lot more risk of underselling because you can always just drop rate and sell and fill less rooms. But as you grow in inventory, that risk profile switches, but people don't like change their kind of perspective, so they continue to always overprice. But there's actually more consumers willing to purchase further out than kind of what the data will show, because our industry keeps the prices high. I bet you and I usually talk about this next on asking rate, and we'll see how big it is here, but we'll pull off 2023. We know, so this is just at the market level. We're not looking at like any different facet here, but on average, you know, Q1 was all right. Prices were pushed a little bit. That makes sense. Hotels are doing it too. We've started to see attrition in March and April, but the average rates that are being posted and advertised haven't gone down at a market level, right? They're actually still up year over year. And then that trend continues all the way out. People keep their rates very high in this industry. Now, if I switch this to just the top 15 to 10%, you'll notice that, so what I'm doing here is this performance. This is about, depending on the size of the market, it's about the top 15 to 20% of like revenue performing properties over the last year for their segment. So this is like not future looking, it's past looking in terms of like which ones have been doing the best. Just from a trend perspective, those top performing properties in a period are much tighter going forward. They start to rise up here, and it's probably because it's so far away. But you can already see that the properties that have performed the best in the past, their kind of like future aggregate is not pushing that rate above their historicals a lot. And so from a strategic perspective, what I usually recommend to people, ideally before they start to feel the tightness in the market, but especially if you feel the market is being competitive, is go check your pricing against your historical pricing in the future. Like, don't assume the booking window is just shorter. Assume that you might be overpriced for the consumer. And a good way to kind of like mitigate your risk is oftentimes people have premiums on their price over what they actually actualized last year. And you can just go adjust that, right? It was like, hey, you don't have to cut under what you did last year. You only have to cut under what you were posting. And honestly, the way that pricing systems work, sometimes it's very hard to be aware of that. But if you're able to do some analysis where you're like, hey, this is the average price I'm posting in these properties in little late in May, like we're within 30 days, so you can't really do it there. But looking at this kind of like August through October timeframe, average out the prices that you have posted out there, average out your ADRs, maybe take out any like really low outliers. But it's something to consider. If you always book last minute after your last minute discounts are in place, that means you're always posting a price that's higher than what you're actualizing, right? And I think scale is important there. The more listings you have, the more you want to build up in price. If you have less listings, you actually do probably want to hold, because you know you can always sell 10 or 15 listings within a week. And if you undersell, you know, you don't have the ability to actually raise the price on stuff because you don't have enough data to extrapolate from. So there's that weird shift in risk tolerance based on how big you are that I think a lot of companies in our space struggle to grow into, which causes the market level to consistently be overpriced in the future. Like, not just overpriced to the consumer, because we don't really know where the consumer is. It's actually overpriced to their own actuals. Okay, that trend I think is pretty interesting here. I've been looking at that. There's one market I'll bring up as an example that for whatever reason isn't doing this. We just met with the Outer Banks in North Carolina. They've had a pretty stable, they have pretty, you know, really they make all their money in the summer. They have a little bit of business in the spring. They have a really strong Easter but not really strong spring breaks. They had a little bit of pressure in Q1, had a pretty solid Easter, and then they're pacing very, very well for this year. Across all market segments, their rates are pretty stable to last year. They are not pushing their rates. And even though their markets are experiencing the same macro conditions all of ours are, they're just not pushing their rates much at a market level. Like, the whole market is more stable from a pricing perspective. I think that correlates to the pacing. Most markets I look at, you see this kind of trend where, like, across the market, average posted prices are higher across the board. There's occupancy pressure now. And then this isn't always true, but oftentimes the highest performing groups are a little bit tighter to their historicals. They're pricing more without as much of a premium, right? That's not going to be true everywhere, but it does seem to be something that I would make a bet that if I looked at a market and saw it was under a lot of occupancy pressure now, that I would probably see that. Okay, cool. So anyone have any questions? Do you disagree with me? What do you think about that from a strategy perspective? I know, like, rate isn't the only thing.
Well, the one thing I would add to this, which, I mean, the data may back it up with what you're seeing there according to strategies. So what we did with our rates is we did kind of revert back to pre-COVID rates. So like what you're suggesting is kind of what we're doing with our practice. However, we're not going too low, especially out in advance, because the one thing that we definitely are noticing is our booking window has shrunk considerably. So we try to have those a little bit higher rates further out just to get the bookings that are trickling in. And our biggest practice is the focus on closer arrival dates, because like I said, the booking window has just shrunk a lot, so we don't want to be over committing to lowering our rates too much in advance.
Yeah, I think that makes sense. From a strategy perspective, that advice I'm giving is really just to check that you're not pricing at a huge premium above what you've done, especially in a year that seems to be under pressure. But it's hard because there's like, have you guys, I don't know if you guys have been on the revenue management roundtables, it's come up a few times, but this concept of the missing middle, where like the advanced booking window has been really strong, and then the short-term booking window is really strong, but like that kind of like 60 to 90 day window has been a lot weaker this year and last year too than it has in previous years. People aren't quite sure what to do about that. I think some of that is that the market's price a little high, but I think some of it is also just consumer behavior shifting a little bit. I think that it's hard to trust out. You don't really know, right? The only way you can do it is that you can kind of test to see if people are booking at different price points. But you can only really do that if you have enough volume of inventory to be able to absorb it, right? If you only have a few units, it's hard to give up like a whole unit to try to test if the consumer is actually purchasing 20% under what you want it to book. And even then it's not. It's hard to make that case to an owner unless you have a lot of inventory or data. One thing I would wonder here, and keep in mind, we're just looking at these top levels. So some of these things break down when you look at your specific regions, specific neighborhoods, but let me pop this off. I mean, this zone is going to be pretty big because that's going to be where we are in the missing middle. In a lot of markets I've looked at, the pacing has been a little bit weak in this area. I mean, we're under, over 50%. We're actually higher already in June than in May, which isn't bad. Better than some of the markets I've looked at. May's at about 50%, which is a little low for where we are in the month. And I'm just using my own heuristics for this. Let's see. Oh, sorry, I wanted to do this. This is the high performing group. So what is the all? 15 to 42, so 83 to 59. That's also a little more than a third. So the high performing group is pacing a little better than the market as a whole, but it's not like, it's not like massive. It's not like they're like priced so much lower that they're pacing super far ahead. So it's one of those things where it's like, I don't think there's a clear consensus among any revenue manager I talk to whether, and in reality, you can't like, sometimes even if the consumer does want to spend at a lower rate, you just can't make the case to do that until you're within a certain time period because the owners won't accept it, right? It's almost like they have to accept it in hindsight if that was the case. What is your guys' booking window for summer normally like? Do you take most of your reservations around this time?
For the summer, we do have a smaller booking window. It's just by this time, we definitely usually have a lot more occupancy than we do. And that's like what our main concern is for the summer right now. I mean, we are expecting it. We're just like everyone else, we're just trying to come up and be creative with ways to, try to increase our occupancy as well as hold our ADRs if possible.
Yeah, sometimes a contradictory problem. We do have some data around booking windows. I don't tend to pull it up on these calls because once you start looking into the booking window data, you really need to start looking at like each different like bedroom count. It's hard to look at as an aggregate because I think it's not as meaningful. But we're going to do it for a second. This is 2025. I want to look at 20. We're at 20. I need to look. Sorry, I need to look at the historical. I don't want to look at the future distribution chart because obviously the future distribution chart is going to cut off however many days away we are. 50% here. 50% is 45 days. It's pretty far. Because how far are we right now? We're like 75 days, maybe. Is that correct? From the end of June. 5%. Yeah, I mean, you're not looking at all the other markets, but this does look like pretty, this 50% point being at 45 seems pretty far out. So it does seem like, I don't know what you guys are pacing right now, but it does seem like that summer period should be booking kind of early. Like it's not completely last minute. There's obviously going to be a lot of last minute business, but when we look at like markets across the South that have strong summers, even there, like really strong high season summers, even their kind of like 50% mark at the market level is closer to like, is around this point, maybe towards 60, and they're going to be like, that's their like peak season. I would have expected this to be a little closer to like 35, 30, but again, it's hard to dig into this data on a call because we got to really look at a whole bunch of different things and that kind of stuff. Can be useful for you. How are you, like, the difficult part though is like if you're pacing behind and you're already kind of like at the same pricing year over year, when are you going to let go of like trying to maintain that ADR? Dan?
Yep, sorry, I had myself muted. We're like picking and choosing because it really does come down to knowing your properties and like what guests are looking for. Some, like I said, some of our unique higher end properties we've increased and they are booking. It's the ones that were really struggling is like our median range properties or lower end properties in trying to maintain the higher ADRs or even same ADRs before working with the owners of those properties. I think that's, you know, where our biggest challenge comes. So using this data and everything that we're discussing to try to communicate to our owners, you know, that's one strategy we're looking towards big time to try to help with lowering the rates, because we are noticing, you know, with the lower ADRs, those properties in the median range, with the owners were willing to go lower, they are booking, and we're starting to see summer bookings starting to trickle in over like the last couple of weeks. It started picking up.
Yeah. Do you expect that short-term window to be occurring at an even lower rate position than what you currently have though?
So it's kind of interesting because we manage it, even though it's a short-term vacation rental, it really is like a hotel. So we're getting both ends. Our short-term vacation rental properties we're holding a little bit stronger on that. Whereas our hotel, like you mentioned earlier, we have significantly dipped our rates. And that has produced a lot larger of a pickup over these last couple of weeks for the summer. So it's really, you know, the ADRs for the hotel part was a big part, reducing it. And so seeing the pickup that we're getting from that, we're trying to hope that that same thing will scale out to our short-term vacation rental properties as well.
Yeah, that's interesting. I think in a way, for anyone else listening, Dan's telling us that they're using their hotel to figure out where the consumer wants to pay, and they're hoping that the consumer starts paying a little more for those vacation rentals.
Correct.
But that becomes the risk, right? And this is something I think revenue managers are grappling with across like pretty much every market that's under pressure right now. Is the owners have an expectation of a certain ADR, whether or not that's realistic. There is a kind of an understanding that like the short-term window is probably going to be pretty strong. Like the last minute booking window will probably be strong, but I think a lot of people kind of ignore the fact that that's usually going to occur at a rate position that's like 20, 30, maybe even 40% lower than your current rate position. And I think like the savvy strategic place to be now is like find the acceptable point in between that and try to make that sale now. That's like maybe a little lower than an owner expectation, but like in a position where you can still explain it, but it's going to be a win in 60 days, right? Because the only place to like really hold the rate really, really strong is if you're pretty confident that that booking window is truly going to be short and in really high demand. Where there are situations like that, or where you're not going to be able to have a conversation with the owner about lowering their rates, and they're just going to have to eat it. Is like them eating it is the only way to like have that conversation with them. I would say in a larger portfolio, it's like find what properties you're willing to do those experiments on and don't do it on all of them. In a smaller portfolio, it's a little hard. You kind of just have to like make those little movements as strategies over time. But now would be the time to do them for summer, because I mean, June's getting a little close. That's going to probably start hitting whatever automations you guys have for last minute discounting and anything you do to drop that. But July is a place where you could still do that. You know, check if you're way higher than what you did last year. Use that as the first starting point. Maybe drop it like 10 or 15% under that. Maybe not 15, that seems a little high. And just see if you can get a little bit of that early booking. But it's going to be hard, right? Because I think those macro conditions are obviously unstable as well. Okay, cool. Well, did you guys have, I don't want to belabor this, kind of market report. You guys can get access to it. I do have another piece that I can kind of show you. I built a specific set for South Lake Tahoe. So with Wheelhouse, you can build like kind of your own market reports. Now there's a little bit of difference in the data. Essentially, you have the capability to choose any location and select at a listing level up to, you know, anywhere from like a small amount of listings to build a comp set and pull that data across and kind of link it to your listings. Or you could pull like entire market sets. You know, you can basically draw an entire city and include all the data in it. This sets data that I built this off of is going to be primarily scrape data. Like not primarily, it's all scrape data, right? When we're looking at the market report data, because this is aggregated in a way that you can't get down to the listing level, we include all of our direct source data, so all of our direct reservation data, all of our key data, partnership data. When you're using the set data right now, it's really just, it is the scraped data and then estimates of what those things are doing based on our model, which is trained on the direct data, but we're not actually revealing the direct data for our customers on this side of the platform. So I think it's good for one, looking at calendar information. If you have like specific sets of listings you need to track for people, it's also good at looking for just general trends in specific neighborhoods. But, you know, sometimes you want to just remember that like they're going to be a little bit more of an estimate than they're going to be exact due to the nature of this data source. In South Lake Tahoe, we have pretty similar trend here. You know, we're not seeing too much different. Now, I think the April drop off is much higher, which is pretty interesting to note. And this is a set that it's about 500 listings. We're looking at all bedroom counts. They were open for at least half the year last year and had an annual occupancy of 60% or plus or more. So I did filter down according to some criteria. When I built this set, this does concern me a little bit. When we looked at the market level across all of Tahoe, that June situation looked a little stronger, but this looks a little bit low to me here. This is still about a third in May, but this is like, you know, still about a third, but we were a little bit more of a proportion when I remember looking at the market data, but maybe I want to call me out on that. The thing I did want to pull up here is we do have some pacing, and let me pull this into a different view. Let me see if I can explain this in a better way. So this is that set that I had pulled up. So when I have it here, we're just kind of looking at the monthly averages. This is a week by week kind of like adjusted occupancy level compared to where that was last year in this same set. So you can see kind of May forward and into the summer, the pacing is quite a bit behind. And when we're looking at like new reservations, that's what's highlighted. So this pace is not always super bad in terms of like what was sold over the last 2 weeks this year compared to last year. You can see we're pacing down a little bit here, but there are some dates that are actually starting to sell more than they were last year, but that July period really seems to be falling behind across this market set. Kind of just corroborating what you guys are talking about, which is that the pace is behind in this summertime period. The sales side, it continues to be behind a little bit in this short term, and definitely in July. June, a little bit more mixed, actually. The actual week to year over year sales is not quite as bad in that June period, but you know, I'm just looking at the last 2 weeks, last week. Okay, we've got about 10 minutes. Do any of you guys have any questions for me or anything you wanted to cover or go over? Sometimes I would take some time to like build a set with you guys if you were in a specific region you wanted to cover, but I don't think we'll have time to do that today.
I'm curious about if anyone has any comments or so like one of our biggest things that we're really noticing that has a little bit of a concern, even though we have a ton of time to deal with it, is our winter pacing for properties that we have available for a full year. Our winter pickup is like extremely behind compared to previous years.
Yeah, does anyone else have a comment on that or a thought?
Not
I
really.
do have some, sorry, go ahead, say that again.
Oh, we don't open our calendars for winter until usually like midsummer. So no, not really.
Yeah, we usually have ours open out for a year with some of our properties, because this far out we usually are, you know, we're asking for a lot higher ADRs considering when the guest would be looking and trying to make these bookings. But those properties that we usually are getting, you know, bookings this far out in advance, even with our rates going back to pre-COVID time, it's just really slow. Like our big time that we're noticing this is like Christmas, especially over that break, where we usually already have stuff on the books. We barely have anything right now, and it's a little concerning. And I was just curious if anyone was experiencing the same thing.
Yeah, I mean, the market data that we're collecting is pretty much non-existent for January, very, very small for February, and pretty much non-existent for December. And that includes this is from the both direct source and scraped. One thing I can give you a little color about what some of our friends in Colorado have been saying over the last few months. They have seen they're having some similar problems with that middle register of properties, but and especially with their like lower quality stuff. They're not seeing that come in as good. As like you guys have said, like the low stuff is just selling. It's the mid stuff that they're having trouble with both. They did mention on the last couple roundtables that I've had ski people on that they are seeing pretty good early booking in their luxury segment. And that includes like really like that kind of next year booking in that top level segment. So the Colorado side seems to be doing their ski stuff seems to be doing fine. I don't know like what the expectation here. That's kind of a good question. I don't know if Josie or Yadira or Nicole, if do you guys also keep your calendars open? I know Katie said they don't open theirs till summer. When do you guys open your calendars for next year?
Ours are open. We're seeing the same thing that Dan is. So it has me up as Josie, but I'm Jeff. So there you
go. Okay, Jeff, I was wondering where you went.
Yeah, I'm still here. My daughter's been screwing with my computer, so therefore I get Josie.
Okay, cool. Yeah, interesting. That one I don't have too much color on. I mean, we're obviously not seeing too much. Getting to pacing is a little bit harder for me that far out, because to be frank, most of the market inventory probably isn't open past a year. That's pretty common in almost every market. If there's like a precipitous drop off at a year. I do think that opening calendars to 365 days is something you should try to do. Especially even if the price is like super duper high and you're not trying to optimize it. Most of the channels are going to penalize you from a distribution perspective for not offering 365 days. But
And one thing that I did see last year, especially January and February, is with, we used to have a very, very strict cancellation policy, and the industry's kind of gone away from that. And so what we were seeing was a lot of last minute cancellations where people were gaming us against other properties. And so they'd wait until their last day to basically cancel on us. And some property that may have been priced double where they were originally priced, dropped the price right at the last minute, and they were able to book another property and cancel our reservation. So we saw a lot more last minute cancellations as the season, kind of went on. And that was a new trend. I'd never seen, people gaming and basically canceling bookings to book something else at the same price. That was a, property that was originally priced twice as high. So I would say that's probably the biggest difference that we saw last year versus, previous.
yeah, I think that's a good point. That is something that has become much more prevalent in particularly like the beach markets. You see it a lot more and urban markets have been dealing with this for a long time, right? That's partly why, like, when you compete against hotels, hotel pricing stays so much more stable because you can cancel them, right? Or no show. You just don't have to pay if you don't show, right? For the most part, unless you book it on an OTA. Those policies have started to change, but I think that what it really promotes is a need for the market prices to be a little bit more stabilized if cancellation policies collapse further, right? Especially if you get into like really last minute cancellation policies. These premiums that people are hoping to capture just because they're early end up not totally being there, because you get all of this, even though like, and I think it shows in the markets where like the last minute booking window is super hot. There's tons of sales coming in, but there's actually also a lot of churn in the reservations across the market. So there's not as much net new business as it looks like that people should be expecting, because you get some trading. Now, I also don't think like a ton of people are willing to do that if they feel like they paid a fair price, right? There's always going to be a segment that is going to be looking to optimize their own, economic advantage, and that's totally reasonable. Those are the rules that set up. I don't think you should make it more difficult for the majority of your people to book, to try to like protect against these people who are, say taking advantage, but at the end of the day, it's like they're just making the most of their own money. And if they can cancel, and there's a great property who priced themselves poorly and now has to sell at the last minute, hopefully that doesn't happen. But I think that I have seen some owners start to put in a lot of restrictions or really try to like keep people from doing stuff or do weird things. And I don't think it's a big enough percentage of people. I think the bigger problem here is that, and you're gonna benefit from some of it too. But at the end of the day, if you're not trying to push a huge premium, like it's this difference between like the price at the last minute versus the price that people are charging. And if that's too unoptimized, like there's too much of a premium further out, I think it just builds the risk. I think over time, the market itself will start to stabilize a little better, or it should. But at the end of the day, I don't know what you do about that. Are you all seeing that though? Are you seeing that kind of like cancellation? One, are you changing your cancellation policies? Two, are there some trends that are coming out of it that you're now having to react to that you didn't expect to?
We've opted not to change our cancellation policies. We're at 30 days, which is pretty standard for our competitors in the area. we have like my VRBO rep has definitely been like, you need to switch to 15 days, and we have not done that. We do see a little bit of people canceling right at the last minute and then booking other properties, but honestly, if the competition is doing a 30-day cancellation policy for the most part, we're already putting discounts on if they're closer. So we have decided that it isn't advantageous for us to lower that.
Yeah, Jeff, how much, you said you used to be strict. What did you currently bring it to? I'm curious, just asking you guys. I want to know where the market kind of is roughly.
We brought it from that 30-day. We previously had a 60, and it was well, we were super strict. So we were non-refundable, balance due at 60 days. We moved it into 30 days. And so we went from a very, very strict cancellation policy to a, with the, the market.
Do you keep that super strict on any properties?
We do. The super high-end properties, absolutely. Properties that rent for, 5 to 10,000 a night, it's always non-refundable.
Yeah, good. I was gonna say, like, I think cancellation policy probably shouldn't be a company level policy. It, as much as your reservation agents, and I'm sure hate that, it really should be set according to the inventory. And also, like, a little bit the performance, right? Like, if you have properties that are just consistently underperforming, those are the ones to try more flexible cancellation policies on, right? Particularly that, like, I think that, like, mid level and the lower level, those are the ones that are potentially going to benefit the most, because, like, you're already pricing them lower. If you have big premiums on them and you're struggling with them, it's probably like you're just charging too much money for them, right? Or you're expecting too much for them. But I really don't, I don't see any reason to drop those cancellation policies on the really high end stuff. I'm hoping that the OTAs allow people to set cancellation policies by time frame. That's what I want. I want to have a different cancellation policy for winter than for fall.
Yeah, we've been discussing that with our account managers from both Airbnb and VRBO for a while now, and it sounds like VRBO might be introducing that somewhat soonish.
That would be good. It would be good. Or even just offer it as promotions. That's something that I think, direct marketing, and I know we're going over, so I'll finish this statement, then I can maybe stay on for a minute if you wanted to ask something else. But promotions are actually also a great way to play around with cancellation policy if you have a decent CRM of previous guests, right? You can email guests and offer them a different cancellation terms. So, like, if you're like, hey, we're in the 30-day window, you normally have I don't know, that's not going to be a good example, but there are situations where, like, right now, hey, September, October, maybe going to be a weak season. Let's email all of our past guests who've stayed with us really anytime and say, hey, book now, we'll give you cancel anytime cancellation policy for early planning for fall, great fall hikes, things like that. Put them on the books. Maybe you have like a non-refundable fee, but there's like things that direct marketing is where there's a lot of room to kind of play with this. You obviously have to have a big enough CRM for that to be worthwhile. But maybe if you're really savvy, you could find, if you're small, you can find some other small customers and maybe pull your CRMs and build a little marketing engine between a couple small companies. That's probably what I would pursue, but I don't know how that would work. I don't know how big all your guys' portfolios are off the top of my head, so you'll have to decide. But that direct marketing stuff is, I think it's funny. When I started in the industry, like years and years and years ago, it was all about CRM direct marketing. And when I went to like the conferences this year, I feel like all the software companies that went away that were offering that, they've all come back in a new form. It's kind of funny. Anyway, any last questions for me? Otherwise, I'll let you guys go.
Nope.
Thanks for the data, John.
Really appreciate your guys' time. I didn't get into it too much, but a lot of this data is free. That performance page where we were showing pacing, we are actually also offering that entire business intelligence suite for free now. We just started advertising that, but you can do so. You can see all of your properties pickup, statistics, things like that. If you'd like to talk to us about it, we'd love to give you a kind of walkthrough and show you how to use it. Anyway, thanks, guys.
Thank you, John. Appreciate your time.
Appreciate you as well. Bye.
Thank